It begins with just $5. It's 6:40 in the evening and you're standing at the counter of a convenience store with a $5 bill already in your hand. An energy drink is cold against your palm. Without making eye contact, the cashier pushes a scratched ticket toward you. $5. No real thought goes into it. Most people don't think twice. $5 is the perfect amount to spend without reflection. You scratch the ticket in the parking lot, using a coin from the cup holder. Nothing, you expected that. You toss it onto the passenger seat beside the others from earlier in the week. Take a few sips from the can and drive home. By tomorrow, the moment will be gone from your memory. And that is exactly why $5 matters. It is small enough to disappear unnoticed. Now keep that same $5 in mind. Because this is a story about what happens when that amount is repeated every day for 40 years and how it quietly determines which version of your future you end up living. Two possible paths, the exact same $5. You are 25, the next evening looks familiar. Same store, same counter, same cashier. But this time you leave the ticket where it is. You skip the drink. You walk back to your car empty-handed. Then you open an app you downloaded the night before. You transfer $5 into an index fund, the entire market. One simple action. No predictions, no strategy, no drama. The balance now reads $5. It looks almost ridiculous. Like a child's first savings account, it feels too small to matter. Like planting a single seed in a field and pretending it's the start of a harvest. There's no adrenaline in it, no excitement, no instant reward. Just $5 sitting in a fund that owns a tiny portion of many of the largest companies in the world. The next day, you do it again, then again after that. Eventually, you automate it so the decision disappears entirely. The $5 leaves your account before you have the chance to spend it on something temporary. About $152 each month moves towards something you cannot touch. And strangely enough, you hardly notice it. That was always the interesting thing about $5. It vanished either way. You simply changed its destination. 1 year later. The first proof, you are 26. A year has passed. Your balance is roughly $1,900. You contributed $1,825. The market added the remaining amount on its own while you were living your life. About $75. A figure so modest it barely seems worth mentioning. You bring it up once over lunch with a coworker. He asks how much you've earned. You tell him. He laughs, not maliciously, just honestly. $75 in a year, he says. I can make that in an afternoon. And he isn't wrong. He buys lunch every day, grabs a drink on the way home, picks up a scratch ticket whenever the jackpot gets attention. Roughly $5 here, $5 there, spread across small comforts he'll never specifically remember. You don't argue, you close the conversation and move on. Because the difference between the two of you after 1 year is only $75. But the real difference isn't the money. It's the habit. And habits are invisible long before they become powerful. 5 years later, when small amounts start looking significant, you are 35 years in. Your balance has grown to around $11,000. You've contributed roughly $9,000 of that. The rest came from patience. $11,000 built from things you chose not to buy. One evening, you do the math and realize what that account represents. The coffees, the energy drinks, the checkout counter purchases, the small impulses that usually vanish without a trace. Except instead of ending up as waste, they became assets in your name. That same month, a friend sends you a screenshot, a coin, a symbol you've never heard of. Up 400% in a single week. He put in $2,000 and tells you to stop being so cautious. Your index fund, he says, earns in a year what this thing earns before lunchtime. He's correct about the speed. He's wrong about the substance. You've seen this pattern before at a convenience store counter, under the edge of a coin, in a parking lot. It's the promise that a small amount can become a large amount instantly with no patience required. You know what that promise really is. Where you come from, it has another name, a scratch ticket. You decline, he laughs and buys more. 3 months later, the coin has lost 90% of its value, and he no longer brings it up. You continue doing the least exciting thing possible with your money. You continue choosing the slow path because you are willing to let time do what excitement never can. 10 years in the return for staying steady. You are 35. 10 years have gone by. Your balance is now approximately $27,800. You've contributed about $18,000. The market has added nearly $10,000 simply because you stayed invested. Then a difficult year arrives. The market declines sharply. Headlines call it a crash. Your account loses a third of its value in a matter of weeks. On paper, it looks like more money disappearing than you earned that year at work. A friend who sold everything during the previous downturn tells you he knew this was coming. He says he's safely in cash now. You don't sell. Not because of bravery, because the truth is quieter than that. You simply keep going. You stop checking the app. You let the numbers move without your involvement. And every month, the same $152 continues, leaving your account, buying the same fund at lower prices. You are not fearless. You are simply disciplined enough to avoid reacting. And in investing, that is often far more valuable. By the time people feel comfortable coming back in, your ordinary habit has already done the buying for you. 15 years in, when the money begins pulling its own weight, you are 40. 15 years in, the market has recovered as it historically has. Your balance has climbed to about $52,600. You've contributed roughly $27,000. For the first time, the account contains more growth than principal. Ride that again. That is the moment everything changes. Up to this point, progress felt manual, like pushing something uphill a little at a time. Now the momentum begins to shift. Your money is no longer relying entirely on your effort. It is beginning to contribute meaningfully on its own. That spring, a coworker loses his job. He has no buffer, no margin. Nothing between him and immediate financial pressure. You meanwhile have a number in the background of your life that you've never needed to touch. And for the first time, you understand something clearly. The $5 was never just about retirement. It was also about resilience. It was about creating distance between yourself and panic. You don't lecture him. You buy him lunch and say nothing. 20 years in, your account starts, carrying its own momentum. You are 45. 20 years have passed. Your balance is now around $89,000. Across those 2 decades, you contributed about $36,000, $5 at a time. And the account has more than doubled that through growth. Something unusual is now happening. The annual gains from the market are beginning to rival what you contribute yourself. Your investments have effectively taken on a second job. That summer, you attend a reunion. Someone arrives in a car worth more than your annual salary. Another person makes sure everyone notices the watch on his wrist. You drive the same car you've owned for years. It's paid off. Griefect. It owes nothing and demands little. Your former coworker is there too, the one who laughed at the first $75. He still buys lunch out, still picks up the occasional ticket, still spends in small ways that feel harmless. Half joking, he asks whether you ever kept using that little investment app. You tell him yes. He asks how much is in the account now. You answer honestly. The table goes quiet in a way that feels uncomfortable rather than satisfying. So you change the subject because the power of that $5 was never in being impressive. Its strength was in how quietly it worked. 25 years. And the gap becomes hard to ignore. You are 50, 25 years in. Your balance has reached roughly $144,000. You've contributed about $45,000. The rest came from consistency, time, and compounding. Now the headlines read differently. They talk about how little most people have saved, how retirement is becoming more difficult to reach, how ordinary incomes no longer seem sufficient, but you are an ordinary earner. You worked the same kinds of jobs, earned the same kinds of paychecks, paid the same bills, spent the same hours in traffic. The difference was not income. It was behavior. You repeatedly declined a small, forgettable expense and redirected it into a broad, unremarkable fund for 25 years. That was it. Friends your age speak about retirement with anxiety, as though it is something looming over them. You think about it differently, not because you are special, but because you gave yourself time. And time did most of the heavy lifting. By now, you've learned something important. Wealth often grows most effectively when it grows quietly. 30 years in, when time becomes the main driver. You are 55. 30 years have passed. Your balance is now around $226,000. You've contributed approximately $55,000 in total. The remaining $170,000 came from growth, not from working more hours, not from earning a dramatically higher income. From time, this is the stage where the math changes permanently. In a strong year, the account may grow more from its own size than you could contribute yourself. Even if you increased your monthly deposits significantly, the machine you built now has momentum of its own. The act of building it is no longer the main story. Its scale is. You rarely mention the number, not to your children, not to coworkers, not even to the friend who once called you too cautious. It has done its work quietly, and that is exactly why it worked. 40 years later, when the full picture comes into view, you are 65. 40 years have passed since the evening you chose not to buy the scratch ticket. Your balance is now about $531,000. Pause and look closely at how that number was created, because the entire lesson is contained in 3 figures. Over 4 decades, contributing $5 a day added up to roughly $73,000 of your own money. The remaining $458,000 came from growth. Money you did not personally earn through labor, money you did not receive through luck, money you did not create through perfect timing. You did not pick the next big winner. You did not outsmart the market. You simply redirected a small amount over and over again into a place where time could multiply it. That is the mechanism. Nothing flashy, nothing hidden. No shortcut, no secret formula. The cost was patience, and most people are unwilling to pay for a result that takes decades to arrive. The other outcome, the same $5, a completely different ending. Your former coworker retires the same year you do. Same type of job, similar salary, a hardworking person, reliable, consistent, decent. He spent his $5 a day on hundreds of minor conveniences and short-lived pleasures, things he enjoyed in the moment but cannot meaningfully point to now. Across 40 years, his $5 a day also totaled around $73,000, the exact same money. He drank it, scratched it, ate it, spent it in fragments too small to notice. Both of you stood at the same counter for years, held the same amount in your hand, faced the same quiet choice over and over. He retires with memories, a pension, and the financial outcome of letting the money pass through. You retire with much of the same life experience and with an additional $500,000 built quietly in the background. No one can identify the exact day the two paths separated, because there wasn't one metric moment. There were only small, repeated decisions. Eventually, those decisions stopped looking small and became two entirely different lives. The decision repeated daily, $5 feels small. Until time proves otherwise, somewhere right now, it is 6:40 in the evening. Someone is standing at a convenience store counter with $5 already in hand. There is a cold drink nearby, a scratch ticket being slid forward without much thought. Soon it may be scratched in a parking lot with a coin from the cup holder, and most likely, it will amount to nothing. That person probably already knows that they are not making a terrible decision. That is what makes it so easy. So, $5 feels irrelevant, and that has always been both the danger and the opportunity. It is too small to demand attention, which is exactly why so few people protect it, and exactly why it can shape a future so quietly. You were never likely to feel the loss of the $5 in the moment. The real question was always what that repeated choice was turning you into over time. The real point. The lesson is not that $5 has some magical power to make anyone wealthy overnight. The lesson is that small actions become routines. Routines become years. Years become capital. And capital, when given enough time, begins working in ways effort alone cannot. Most meaningful financial change does not feel dramatic while it is happening. That is why so many people overlook it. You do not become financially secure because of one perfect decision. You become financially secure because of many ordinary decisions repeated consistently. One small choice, then another, until eventually, you look back and realize those modest actions built an entirely different future. The amount was never the real story. The direction was, and so was the time. Every day, you are doing one of two things with the money that feels too small to matter. You are spending it on something that disappears, or placing it somewhere that can remain, compound, and eventually begin working on your behalf. The choice may feel insignificant today, but after 40 years, its impact will not be. You cannot control what time will turn it into. You can only decide where it goes now.